Hello, everyone. I'm Miles. If you want to get into investment banking, private equity, or professional accounting, then deferred tax assets, DTA, and deferred tax liabilities, DTL, are definitely not just accounting details. The reason deferred taxes exist is actually really simple. Accounting standards, GAAP, and tax laws, IRS tax rules, aren't measuring the same thing. GAAP aims to reflect true economic performance, while tax laws are designed to influence business behavior and regulate the timing of tax payments. Because of this, and this is really important, accounting profit determines valuation in deal logic, while taxable income determines the actual cash tax burden. The differences between the two create taxes that will either need to be paid or can be saved in the future. When tax rates change, these differences can cause billions of dollars in profit swings overnight, even though there's no change in cash at all. If you ignore deferred taxes, you're misreading the financial statements. A deferred tax liability means that tax laws allow a company to pay less tax today. It means postponing the payment of taxes to the future. This isn't tax evasion, but rather tax deferral, deferred tax assets. This refers to situations where accounting has already recognized an expense, but tax laws temporarily don't allow it to be deducted, so the company pays more tax today and gets it back in the future. So compared to these accounting and tax rules, am I paying less tax or more tax today? Next, let's learn by working through some problems. Case explanation: Omega Company's annual accounting pre-tax profit is 100 and the tax rate in 2024 is 20%. Transaction 1 involves equipment purchase and deferred tax liability, DTL. The equipment cost is 60 and accounting depreciation is 20 per year. GAAP income tax expense equals 100 minus 20. At 20%, that equals 16. According to the tax authority's rules, the entire 60 can be deducted at once, so the tax payable is calculated accordingly. That equals 100 minus 60 times 20%, which is 8. So now the tax payable of 8 is less than the GAAP income tax. This creates a deferred tax liability. The deferred taxable income is 60 minus 20, which equals 40. The DTL is 40 times 20%, which is 8. Transaction 2 involves warranties and deferred tax assets, DTA. The accounting estimate for warranty expenses is 60, but according to the tax authority, only cash payments are deductible. In 2025, it's 30, and in 2026, it's 30. Since the tax authority does not allow immediate deduction, the deferred deductible expense is 60, resulting in a deferred tax asset. 60 times 20% equals 12. At the end of 2024, the net deferred tax item is DTA 12 minus DTL 8, so the net deferred tax asset is 4. Next, let's take a look at the linkage between tax rate changes and the reevaluation of deferred income tax. At the beginning of 2025, the tax rate increases to 30%. So DTL equals 40 times 30%, which is 12, an increase of 4. DTA equals 60 times 30%, which is 18, an increase of 6. Therefore, the net impact on profit is plus 2. There is no change in cash. What changes is the expectation for future profits. Conversely, in the real world, the 2017 U.S. tax reform reduced the corporate tax rate from 35% to 21%. As a result, Verizon's deferred tax liabilities dropped from about $48 billion to $21 billion. This resulted in a huge one-time gain being recognized. Meanwhile, some large U.S. banks saw their deferred tax assets shrink. There were multi-billion-dollar profit shocks, but this wasn't a business issue. It was a revaluation of deferred tax items. So, deferred income tax has never been just an accounting trick. It's about timing incentives and expectations for the future. Accounting profit tells you how the company is performing right now. Tax rules tell you when cash actually flows in or out. And deferred income tax tells you how today's decisions are reshaping the future, because the essence of financial statements is actually a map of past and future cash flows, and how those cash flows are priced in the present.